Steinhoff full-year results showed a 25% rise in headline earnings per share to 395 cents. Now, the furniture retailer saw its revenue rise to 115 billion rand, while its operating profit rose by 41% to 11 billion rand. Now, the company's chief executive, Marcus Worster, joined us earlier to unpack the numbers.
Look, this year in terms of turnover growth might now look a little bit better than what the figures show, because as you know, it's the first time the full year consolidation of the JD Group and CUP. But to have achieved the annual turnover of 115 billion rand after 15 years as a listed company, and we started the first year with 3 billion, obviously that is a milestone for us to have broken that 100 billion mark. But it has been a difficult year. I mean, it's definitely not been easy. I mean, Europe is very tough, as you know. South Africa, since about December, the market changed, as you know, here in the local market with the consumers under pressure. So it has been a year where a lot of our focus was on maintaining top line, but improve the profitability. So we cut costs where we had to. But mostly, for me, the highlight of our performance was that our retail operations in Europe, virtually in every country, we took market share from the competitors, and they improved their margin, which is very important in such a tough market. And of course, our group initiatives paid off handsomely. You'll see that the margin on sourcing and logistics and trading went up from 8.5% back to 10%. And that extra volume that the Conforama Group brought, and with the expansion of the European business, is really starting to pay off for us. And obviously now with Kika Liner coming into play, that's a further €1 billion of turnover, which obviously is going to enhance that effort of buying better, using the group's volumes all over the world to make better margin for our retail companies.
Marcus, just keeping on with Europe there, like you mentioned, that it has been a strong or rather tough economic environment to continue your operations in. But I guess with the changes, have you maybe changed your strategy slightly there, given the fact that a lot of European countries are coming out of a recession recently?
Look, we've seen an improvement since about February, March. You could slowly feel it coming through. And funny enough, in Portugal and Spain is where it started to improve slightly in the latter part of the year. We are in the mass discount market. So, I mean, there's not much of our strategy to change at this point in time, rather than to offer the best value for money is what we try and do in all these countries. And the last year it's worked very well for us. So the promotional, aggressive advertising and to be in the front all the time of your competitors is really what it's all about. So it is a daily fight. I mean, we will continue to expand. We have rolled out quite a few new stores in this financial year, so we haven't stopped to invest. So that is continuing all the time. We bought in a lot of properties that we rent at very favorable prices. And the foundation for the year to come is very solid. But again, I have a feeling from all our CEOs throughout Europe that the drive will be to maintain top line at the levels we are operating. That means, again, taking a bit of market share from competitors, but the main drive is to improve profitability now.
You mentioned cost cutting there. What exactly does that entail?
Well, you know, we have distribution centers which serve different brands. So to consolidate that into one, we spent more than R1 billion on properties to centralize distribution, to share costs. The IT platform cost a lot of money. You saw there we wrote off nearly 350 million of IT costs, but hopefully that is behind us. And therefore, once those efficiencies through the central distribution and having a single platform come through, the costs will come down.
Let's take a look at CAP as well, which is one of your South African operations that has also recently come on board. What's your long-term strategy for that one?
CAP is a very special business. They've got fantastic companies and businesses in the industrial field. Their philosophy is to only invest where they are either the number 1 or 2 in the marketplace in Africa, where the barrier of entry is enormous, that it's not possible for anybody to come and compete today to put up these kind of plants. So, and then it has to be a strategic product. So if you think about their automotive products, you think about PG Bison, all the wood, You think about Hossaf with the PET supply of every plastic bottle that you see in this country. It's a great business, Cup. So they will continue to grow. They now have their own platform. They delivered results better than what we expected. Their cash flow was fantastic. And Unitrans, as a logistics supplier in Africa, is one of the best logistics companies around.
Marcus, we also know that properties, or your property section, is a rather large contributor to your top line. Do you think that you've extracted enough growth out of that area, or are you looking at another area within your business to see more growth from?
Well, you know, the property is a long-term good investment if you buy right. By the same token, if you are the tenant in a property and you can afford it, it's much better to own it, which we have done. I mean, interest rates are at an all-time low in the world, especially in Europe. So we have made within healthy covenants use of our good cash flow to buy in as many properties where we operate in to own it. So the property income will keep growing. And you must remember, if you own the property, that increase or escalation in the rent that comes through from retail every year comes back into your pocket. So it is long-term the right thing. It also de-risks the business substantially because you are now secured of your properties, because you know what it's like. If you're a tenant and your business is hugely successful, the next time around, whether it's 5 years or 10 years and you have to renegotiate with the landlord, then you're the one paying him. So that strategy has always been on the back of our minds, and with our cash flow of 13, 14 billion rand a year now, we can afford to buy and invest in properties and in the footprint of the company. So it's not really saying it's a specific growth area, it is a necessity.